Welcome to the video, what you have been doing wrong trading, day trading and losing. So you may have decided that you want to give day trading a try and you've saved up 30, 40, 50, 60, 70,000, maybe $100,000 or more of your own money, quit your job, and you decided you're going to be a day trader. Problem with this is you're going to lose all your money, and here's why. You're infringing upon the market maker's territory. Back in the 60s, 70s, and 80s, when people would buy stocks, they would usually buy stocks for the long term. They would get in, they would hold for 6 months to a year, and then maybe they would hold even longer before they got out. So spreads were pretty wide. A market maker is like a glorified bookie. He buys and sells with his own money, and he also provides liquidity for the public who buy and sell. But he does this for a price. The price is something called the spread, the bid and ask. The market maker sits there all day and trades the stock and makes little slices, a fourth, a 16th, an eighth. He does this all day by matching buyers and sellers, much like a bookie. So he does this all day, and that's how he makes his money. Suddenly in the late 1990s, early 2000s, with the advent of the internet and trading platforms like E-Trade, etc., people decided they'd start doing this and make money trading like this. This infringed directly on the market maker and took money out of the market maker's pockets. Suddenly, it was war. The market makers didn't appreciate the general public coming in and trading the bid and the ask, effectively taking money out of the market makers' pockets. The market makers decided to fight back. As the market makers would sit there on the trading room floor looking at their order screens, they would begin to identify individuals who were making the same trades over and over again, obviously trying to scalp fourths, 16ths, eighths, much like the market makers. The market makers, on the other hand, had a secret weapon. They can manipulate the price of the stock. The way the market maker can influence the price of the stock is sitting there looking at the order screen and deciding which orders he wants to fill, buy or sell. By doing so, he can change the way the stock is moving by influencing the bid and ask so that he can make the stock go up or down. Imagine playing tennis against an opponent who has the ability to also control the tennis ball midair. You can never win against such an opponent. That opponent is watching you on the trading room floor, seeing which way you want the stock to go based on your buying or selling of the stock, and making the stock go the other way to shake you out of your position. So that is why you will eventually go broke. You can never win this game. Unless you are a pro, work for a firm, have an advanced trading platform with level 2 quotes, or professional high-speed trading computers with neural networks while using platforms like Island, you are going to lose your money attempting to day trade. That is, moving money in and out the same day, going for fractions of a point on the bid and ask. Same-day trading is the market maker's territory. That's his business. Stay out of the same-day window. Same-day, repeated day trading doesn't work unless you are the market maker. Ever see the movie Boiler Room, or more recently The Wolf of Wall Street? These two movies are examples of pump and dump schemes. This is common out there. This happens all the time. They even made 2 mainstream movies about it. In a perfect world, a stock climbs in value if it has actual intrinsic value to the shareholders through value to the public that it services, via selling goods or services. So if Hyundai, for example, sells a good quality car for a fair price and the public starts snapping them up, Hyundai is going to start making a lot of money and the stock price is going to begin to rise. Value increases due to physical value it gives to the public. A pump and dump scheme is different. A shady company will pick a stock that is low price, usually a penny stock, that has gone nowhere for a year or two. It's gone nowhere because the company has not done enough for the price to rise. The books say the stock isn't bringing in any money and is returning no value to the shareholders or the public it services. So all the shady investors get together, purchase a penny stock, and buy thousands of shares. Then they get to work hyping the stock. They will usually rent out a call center for this and have multiple people making cold calls, hyping the stock and how it's the next big thing. They may even invent false numbers, background and product, plus false future performance. They will tell the prospective client on the phone that this stock will revolutionize the industry with a brand new product and get in now while you still can make big money. This can be done on the phone or in flyers in the mail or online. After a month or two of intensive campaigning and people start buying the stock price will shoot up from pennies to dollars, making the original shady investors rich. The original shady investors will then sell their high-priced shares for hundreds of thousands or millions and then move on to the next scam, leaving the new investors holding the bag and broke as the shares then deflate back down to pennies. Not all pump and dump schemes are done over the phone. A lot of them are done by mailings. If you've ever been put on a mailing list by something you ordered in the past, you're going to see a lot of these. For example, the hard asset report. This teeny oil stock can make you rich, 558 million, up to a value of 5 billion. All these buy signals, why, expert opinions, multi-pages of graphs, charts, why this sector is going to be hot. And right here it says this is going to be bought out by ExxonMobil, BP, ConocoPhillips. This whole magazine is an effort in order to get you to start buying this penny stock. So now we have the benefit of hindsight with this. Now you can see this says June 2013. So let's see what happened. Now, the stock they were hyping was Polar Petroleum, POLR, no doubt a penny stock. That hasn't done anything. So let's go online here to Yahoo Finance and see what actually happened with this. Okay, now we're on Yahoo Finance. We're on the site of POLR, Polar Petroleum. Now you can see that starting in April and May, all of a sudden the price of the stock started to rise. Now about right here is where the investors, all the shady investors got in. Say April, while it was still at several cents. They bought thousands of shares, okay? And then they started to hype the stock. They started setting out these flyers, probably had a couple hundred people on the phone calling prospective clients to get in now, and can I send you some literature? And look, you can see that the stock suddenly went up to several dollars. About the time this pamphlet came to my house in 2013 in June. Now you can see that it's like at several dollars right here, May, June, and then look what happens. All the original shady investors suddenly sold all their shares and made possibly millions. And you can see this stock just suddenly dropped all the way back down to pennies again. Pump and dump. So you have a sizable portfolio worth millions of dollars. Don't give your money to a broker to trade or a mutual fund. Brokers get paid on commission, not if you make or lose money. Nobody cares about your money except for you. If you only have several $1,000s or even $10 or $20 or $30,000 to invest and give it to a mutual fund or give it to a broker, they just aren't going to give you high enough priority in the trading. They're going to be taking care of their big fish clients. You're not going to get the choice buys, the choice stocks, and they're just not going to be paying that much attention to your account because you're not producing enough commission. Nobody cares about your money but you. Most mutual funds underperform the S&P and the Dow Jones for the year. Plus, inflation. If you're only making 10% a year in a mutual fund, inflation eats up about 4 or 5% of that a year. Can you afford to only make 10% a year with 4 to 5% being hacked off due to inflation? And here's another thing. You better not bet on your 401k to retire. If you've gotten in your 401k in the late 90s, you would have seen it probably gone twice in the next 10 years. You can see here there was a big crash in 2000, 2001, and people's portfolios got flattened. Started recovering again, and then there was an even bigger crash in 08, where your 401k again got flattened in price. Started recovering, but now the financial indicators are saying that there's another crash coming. The next 10 years of working, you would have broke even for the decade. Can you retire on that? If you have a job with a 401k available, especially if your employer matches funds, use it. Just don't depend on it to retire. Trading on the news doesn't work. So you may decide that you're going to try your hand at trading on the news. You're sitting in front of your computer on such web services like Reuters, Yahoo Finance, Google Finance, and you're scrolling through the news items. They all look like they're hot off the press, but in all actuality, they're an hour or two old, and the pros have already acted on it. So everything you see there on the screen is already old news. Pros have access to services like First Call, information right on the stock floor, in-house computer systems, etc. It is advantageous to have the news first before the public does, even though theoretically everybody supposedly has it at the same time, but they don't. Pros get it before you do because they get it earlier in the news chain. How do the pros get the information first? Because that's their business. What it really comes down to is the pros versus the public. If the pros got the information at the same time the general public got the information, they really wouldn't have an edge. Even though theoretically it's illegal, that's the way it is. Over the last 50 or 60 years, they've worked on information services so that it goes through the stock market floor first. The way pros have an advantage is leaked information that spreads like wildfire across the stock market floor. Let's say, for example, a CEO of a particular company knows something that's going to be coming up in his company that's going to significantly affect the stock price. So he's at the country club, he tells his buddy about it, and his buddy tells his buddy, who just so happens to have a large position in the stock. He calls his broker and explains what's going to be happening in the next week. That broker now has a hot tip. The broker hangs up the phone and starts telling a lot of people that he owes favors to or who he wants to curry favors to on the stock market floor. So by the time you see news on a stock on Bloomberg, MSNBC, Fox News, or any web-based browsers such as Yahoo Finance, Reuters, etc., it is too late. As you are getting in, pros are already getting out. As soon as you get in, the stock will start to drop and you'll take a loss. Another thing new traders try is momentum plays using a web-based level 1 browser such as Yahoo, Google, or E-Trade. Even if you have level 2 quotes where you can see how many orders are piled up on the bid and ask, this still doesn't work right. So you're sitting there watching a stock and it starts climbing and it's going up and up and up and you realize, hey, this probably is a momentum play. So then you decide to get in right here, and as soon as you do that, you notice the stock starts to drop. That's because the big boys are exiting by the time you get in. Momentum plays on same-day trading doesn't work. Rolling stocks generally don't work. Daily rolling stocks, weekly rolling stocks. The problem with it is everybody has the same information as everybody else. Look at this chart's past history. It looks like a sine wave here. Everybody can clearly see where the top and the bottom is as the stock goes through the roll. So at the top, everybody wants to sell and no one wants to buy. And at the bottom, everybody wants to buy and no one wants to sell. So basically, volume remains flat. Everybody's just staring at each other from across the aisle. This is especially the case in penny stocks. There's hardly any volume, and everybody wants to outtrade the other trader, and nothing ends up happening. Rolling stocks generally are not a good idea. At this point, you might be thinking, nothing works. If you do the same thing as the rest of the crowd does, you won't make any money, but more on this later. And now we've come to one of the largest reasons why you lose money in the stock market. Say you're at home watching MSNBC, Bloomberg, or Fox News, or reading the Wall Street Journal, or IBD, and a stock has been highlighted in the news for whatever reason, and you start to follow it, wondering when a good time to get in would be. Then one day you notice over the course of the last several days that the stock is starting to climb. You think, I don't want to miss out on this, so you get in. So after you've been watching the stock starting to climb for the last few days or so, you get in. Over the course of the next several days or weeks, you watch the stock at home, on the train, at work. It goes up and down a bit, and then suddenly the market crashes, or your stock comes out with bad news and it starts to rapidly drop in price. You freak out. You didn't invest several $1,000s just to lose it. What if it goes down more? I can't lose money. You start thinking of your bills, what you need, what you could be really using the money for. So fearful of any further loss, you panic sell and get out with a loss. So you end up buying high and selling low. Why? Fear and greed. There is a primitive part in our brains that helped us survive when we were living in caves. As a survival mechanism, we developed a sense to follow the crowd without asking questions. Because if we stayed there and looked around and asked questions, we could have become lunch. Even today, when you're in a crowd and everyone starts running in one direction, you will have the extreme urge to start running with them before you even know what's happening. It's hardwired into us. It's hardwired into other animals as well. This is why stampedes happen. Survival instinct says run with the herd. If you stand there, you'll be targeted by predators. In modern times, this hardwired instinct affects how we trade in the stock market. This is why when the market goes up, everyone charges at it, and when the market goes down, everyone charges out of it. Sometimes when the market's in free fall due to herd action, they even have to institute trading breaks for several hours or for the rest of the day. Then they resume trading the next day when everyone has their head together. If you want to see a great example of this in action, go rent the 80s movie Trading Places and go to the end of the movie in the stock market scene. That's a great example of herd mechanics in action. This instinct affects a lot of the talking heads on the cable financial networks. Most of them were wrong in 1999 when the NASDAQ was at 5,000 and they saw no end in sight. So you now know that saving up $70,000 and trying to day trade it all day long at your computer is wrong because the pros and market makers will make you broke in a game that's rigged in their favor. And you now know that holding long term is a 20 or a 30-year lotto ticket that may or may not pay off as companies go out of business, get bought out, market crashes, etc. Here's an example. A couple of weeks ago, as I was going through my old Yahoo accounts, I stumbled upon my old stock watch lists I'd set up in 1999, 15 years ago. Apparently, Yahoo had been keeping the list current. It was interesting to me as I went through the list that a lot of the stocks I'd picked now say no such ticker symbol, showing that the stock no longer exists, went out of business, or had been bought out. Another thing that caught my eye is out of 20 or so stocks, only one was a Walmart Home Depot home run. When I put it on the list, this pharmaceutical company was at $8. Now it's almost at $200. But that was one stock out of 20, and again, who knew? I would have had to put a few grand on each stock and forget about it for 15 years like a time capsule just to see what would shake out 15 years later. Who has the time for that? Most people don't have 60 grand apart for 15 years on a whim. Sure, if you bought Microsoft in 1986, Walmart in 1990, Home Depot in 1992, you'd have a lot of money. But the only way that's happening now is with the time machine. You didn't do that then because you just didn't know what the future would bring. Or else you would have mowed grass all summer as a teenager and scraped together 1 or 2 grand and bought Microsoft in 1986, 1987, and after holding it for 13 years, you would have had several million. But who knew? It was a lotto ticket. You had better things to do, like put gas in your car for your date on Saturday night or see a concert with your friends. So if it's not day trading and it's not long-term trading, then what is it? How do you make money in the stock market? The answer is using a trading window of 2 days through 3 weeks. This is where the money is, in this window. You will be using crowd behavior to make serious money, going against the crowd. This is called contrarian trading. Contrarian traders trade against a crowd because they feel the crowd overreacts due to panic herd following and extreme cases such as sudden drops or sudden climbs, crowds panic, either running from a predator or on the trading room floor. Remember that part of your brain I talked about earlier that is hardwired to follow the crowd for survival? Almost everyone is powerless against it on the trading floor. When something suddenly drops, people freak out and panic sell. And when something is suddenly hot, they panic buy. It's fear and greed with the hardwired follow the crowd mentality that allows contrarians to make sick amounts of money while everyone else loses. How does this work? Due to crowd behavior, when a stock suddenly has bad news or there is a sudden drop, fear kicks in and there is an emotional overreaction which causes the stock to be oversold past a point where it is now undervalued. For example, this is stock XYZ. Here's XYZ's stock price before the bad news. Bad news hits about right here and the stock price starts to drop. And it should level off around here. Right here is the correct valuation of the stock with the bad news factored in. But due to herd action and panic selling, the price keeps dropping as people keep selling incorrectly. It goes down to this point, which is the incorrect valuation of this stock due to crowd action and fear. This stock is incorrectly oversold. Contrarians ID this. They come in and buy at this point. Over the course of the next several days, the crowd as a whole gets their head together and realizes they oversold the stock, and the stock bounces back to the correct valuation right here. This is the correct valuation of this stock with the bad news factored in. And so this would be the contrarian profit zone. They profit on this zone right here. They profit on the bounce back. The bounce back when the stock suddenly bounces back to the correct spot after the crowds get their head together several days later. Also, due to crowd behavior, the reverse is true. When a stock suddenly has good news or there is a sudden spike, greed kicks in and there is an emotional overreaction which causes the stock to be overbought. So this stock, let's say is stock WGT, here's the stock price before the news, the good news hits and the stock starts to climb in price. And it should level off at this point, which is the correct valuation of this stock with the good news factored in. But due to greed and panic buying, the stock keeps going up in price up to this point, which is the incorrect valuation of this stock due to crowd action and greed after the stock is incorrectly overbought. And here's where the contrarians come in. They come in at this point and they start selling short or buying option puts, knowing that the stock's going to go back to its correct price. And over the next couple of days, the crowd gets its head together and the stock goes back down to the correct valuation it should be at with the good news factored in. So this is another bounce back, and it is also the contrarian profit zone. You can see from the charts above marked in orange, a day or two after the news, people come to their senses and the stock usually bounces back to its correct valuation. This is how contrarians make their money. There is pressure for the stock to bounce back to the correct valuation after the crowd comes to its senses. This pressure to bounce back to the correct price is taken advantage of by the contrarian traders. Due to contrarian traders using the aforementioned crowd psychology against the crowd, they are part of an exclusive group of traders that make the majority of the money while the majority does not. In other words, contrarians are the 10% that make 90% of the money. For example, in the housing crash of 2008, contrarians started buying houses when everyone else was screaming and there was blood in the streets. When everyone swore they would never touch housing again after properties were reduced 30 to 60%, contrarians swooped in with their waiting cash reserves and snapped up properties at a discount. 2 to 3 years later, when the housing market bounced back, so did housing prices as they reinflated to correctly priced levels, giving the contrarians a financial windfall. So why doesn't everyone do this? Because of that part of your brain that screams at you to follow the crowd in times of panic and greed. Let's use the housing bubble and crash as an example. When in 2004 housing prices were skyrocketing and everyone was buying a house, you would have worried that if you didn't get in, you would miss out on perhaps a 50% profit, as it seemed like a bulletproof way to attain wealth. Homes were doing nothing but rapidly appreciating. You saw it all around you. Your job is to accumulate wealth for you and your family, and you just couldn't leave unclaimed cash laying there. Cash you saw everyone else grabbing. So you went with the crowd. How hard would it be to do nothing, sitting in the middle of all this? Not to get swept up in this and just sit there and wait with a pile of money. That's what contrarians did, because the masses are wrong, and the masses, as it turned out, were building a huge bubble. In 2009, the bad part of the housing crash, the house that you bought at an inflated price in 2005 has suddenly dropped in price as the bubble burst. In jumping in to buy, you signed a shady contract where the interest rates went up. You're dying with the increased monthly house payment, plus your equity plunged due to the price drop, and a loan you have out against part of the house has suddenly come due, also because of the drop. You're panicking. You are burning money making house payments on $300,000 when the house is now worth $175,000. It sickens you to sell, but you are broke and you have no choice to sell at a discount. This is where a contrarian comes in, when there's blood in the streets. He ignores the fear of what happens if the housing market keeps dropping and instead purchases the property for $170,000 and holds it for 3 years. In 2012, as the market recovers and prices bounce back, the Contrarian sells the house for $250,000 and pockets $80,000. $80,000 from a bounce back. Contrarians often did this with multiple properties at the same time. What kind of bank do some Contrarian investors make? You'd be surprised. Go to the below link to read up on some of these guys. Also, while you're at it, Google Contrarian Investing on Google and read the Wikipedia site on it. Following cable news programs, the Wall Street Journal, IBD, listening to coworkers around the water cooler, or acting on pieces of mail about stocks that are going to explode put you in the category of 90% of all traders. You may even have a hit every now and then, but you will lose overall. You will have no edge doing the same thing the rest of the public is doing, and occasionally you will even be ripped off. Here is how to join that elite 10% that make all the money. The winning time frame is 2 days to 3 weeks. You're outside the domain of the market maker, and you will be using crowd psychology against the crowd. In this time frame, you will be doing 2 trades over and over again against the crowd. The crowd over and over again will surge the wrong way due to greed and fear almost every time. Here is what you've been waiting for. I'm going to show you how to make 30% a month every month for the rest of your life. A variation of this was reserved for our top clients. Go ahead, do the math and see what happens when you compound 30% a month every month. I'm not talking 10% a year. I'm talking about 30% a month each month. What would happen with 30% compounding monthly interest? If you started with just $5,000, in 1 year you would have $116,000. In 2 years you would have millions. That is the power of compounding interest. When you were trading like this, it's like you're the casino. The deck is stacked in your favor. This isn't a gimmick or a strategy. This is a biological hardwire hack to extract profits from crowd behavior. The herd does it every time. Over and over again, greed and fear overrides their logic. The secret is trading earnings reports in a contrarian fashion. In my next video, I will show you how to make 30% a month using crowd behavior trading stocks in a 2-day to 3-day window before the stock reports earnings. Sometimes you can make 50% or more a month. This is an explicit step-by-step tutorial that will get you up and running so you can do this yourself. We'll show you how to set preset entry and exit points so you take the emotion out of the trade and so you don't have to monitor your trades once you make them. If you just watched this video and you're not currently on my site and found this video on YouTube, for the next video, go to this address below. To find me on Twitter, I'm at TradeContrarian at twitter.com/TradeContrarian.